Good morning and welcome to Equity Story Trade Watch, Wednesday, the 10th of May. I'm here with Claude. Good morning, Claude. Of course, we are alone today. We're going to talk about a thought of the week, which is going to be based on the budget that we saw yesterday. There's some big news coming out as well tonight, actually out of the US with the inflation numbers. And we're going to talk about some of the announcements this morning. Before we do that, you've got Equity Story disclaimer in front of you. General advice, of course. Every stock we talk about is pretty much based on the technicals and the fundamentals of that particular company. All right, Claude. Before we go on, I just want to mention that tonight we've got the CPI numbers out of the US, and I will quickly flick the screen so you can see exactly what I was looking at. I'm getting rid of that. And where are we? New screen, and I want, let me see. Here we go, and there we go. That's what I want. I want this screen here to be shared. Can you see that screen? Trading economics?
Yep.
Okay.
Yep.
All right, so calendar, not news. So you got 10:30 tonight, inflation rates year on year, core inflation as well. So huge news, obviously, out of the US. It's going to probably make or break tonight's session, I'd say, on the US. We're going to be watching for that. I'm going to have a quick look at commodities as well, so you can see what's going on. And you've got the one I was actually interested in. Gold was 237, which is nice. Let's have a bit of a bounce back. Iron ore was the one that sort of bounced a little bit to 107. So that's also something to have a look at. And of course, uranium still 53.70, which saw BOE still looking pretty good on the charts. That's probably our favorite story in that space. Other than that, fairly, even nothing's happening in that space. All right, moving on to some announcements. Let's again flick the screen to this screen right here so you can see what's going on. And I am going to run through some announcements for this morning. So the first one was actually yesterday, Claude, and that was DDR. Now, I know you follow the story a little bit, right? I probably owned it before, like me. We used to own it as well in the funds, but it's just had a little bit weaker time over the last few months, maybe half a year or so. So I saw the little update saying a little bit more positive than previously we've seen. So a little bit more growth. What did you take of that? Because it's up 9% today. What do you think of that update yesterday?
I think overall, Peter, the update is hardening. It doesn't really surprise me to see the market picking up off this, because basically what it says is that despite the headwinds, which is mostly to do with high interest costs from the looks of things, despite the headwinds, they're still growing. And it just goes to show, what a good quality business they are. The demand is there. And on top of that, there is a suggestion that there's probably going to be some further growth, because this particular quarter was impacted by about $500,000 in redundancy costs, which I suspect has mostly to do with a recent acquisition, because they run a pretty tight ship. Might be sacking some of their own people, but most likely it's the acquired business, scaling down. So overall, if you wanted to be a little bit generous, you could say excluding, the costs of these one-off costs, you get a net profit before tax for the quarter of 25.9. And now if you just applied a sort of standard 30% tax rate, that gets you a little over 18 million net profit for the quarter. And then times that by 4, you get 72 and a bit million in terms of the earnings just on the current run rate. And I think that puts it on a P ratio going forward based on the current run rate of about 20, assuming no growth. Now, the general rule of thumb is this is a grower, and the revenue is certainly growing. Where its profit is getting hit is largely due to the fact that the interest costs have gone up as interest rates have increased, and it does use debt to fund its entire business. And that's sort of the one thing that keeps me out of it right now, that keeps me a little bit cautious. But I would actually note, and this is why I actually probably have to revise my view on it a little bit, is I would note that that essentially the gross margins have come up a little bit. And one of the concerns I had when I sold out of this was that gross margins were falling, potentially due to an unfavorable product mix. And so I had dual concerns of falling gross margins and higher interest costs. And I think that this, this result with the stronger gross margins does, mean that perhaps some of my concern has been disproven to a degree. So yeah, overall, it's a positive. I'm probably not racing to get back in this one right this moment, just because 20 times earnings, yeah, it's not too bad, basically, is where I'm at with it. Not too bad. I definitely wouldn't be selling now, because I think there's at least a chance. This is not as bad, basically, as I thought it was the last time they reported. That's where it goes. So it's incrementally improving. That's it. That's the verdict from me. Like it's a positive.
Yeah, I agree. And I think at 20 times, if they were growing at 20%, I'd probably consider it, but they're not. They're still in their single digits, right? Recovering. So maybe that's exactly what's with me. I'm just probably going to wait. Actually, the charts is still not quite there either, Claude. So I think, technically speaking, definitely not there yet, but it's encouraging signs that, this is a story that we really liked before. So if it does start trending, we're probably going to have a look at it for sure. All right, let's look at the next one. And this is a good story because we both like it, right? SRG has come up with an upgrade today, even though it wasn't anything incredible. And it was on the back of also an acquisition that they've made. It's still a decent update saying that, things are looking up. They've got lots of things going on, order book over $1 billion, I think. So generally speaking, it seems like they're still going very, very well. So you still be comfortable with the update today, thinking to yourself, I'm going to hold this. I'm not going to sell it. I'm going to hold this. I'm going to wait for their August reports, pick up the dividends and see how we go. So is that what you sort of got out of that as well?
So I like SRG. I bought it around current price, happy to hold it. In terms of the guidance upgrade today, had a little bit of a mixed bag. So based on the run rate that they bought the acquired company on, you would have expected about 5 million EBITDA contribution over 4 months. They've said that it's contributed 4.5 to 5 million. At the low end, that's a little bit lower than you'd like to see. However, it's the first 4 months of it being, well, it's not even up yet, right? This is they're predicting, and it's the first, it's just integrated. They're just settling it down. So your worry is that, they buy it, they can't integrate it, it blows up, it underperforms badly. I wouldn't say we're there with that. I don't think that there's anything to worry me about the acquisition. I expected 5 million. We've got 4.5 to 5 million. So yeah, not too worried there, but that's the little negative. The positive, of course, is that any way you read this, they're really coming in at the top end of guidance with their existing business there. So, they previously gave the guidance a bit of a $5 million range from memory, something like that. Okay. Now they've tightened it to just a $2 million range, right at the top end of where you'd expect that to be. Plus, of course, the acquired EBITDA. So it's an upgrade, and is an upgrade when it comes down to it, and I'm happy to see it.
Yep, I agree. I think this is still like I said, it's still a keeper, good dividends, inexpensive. Looking forward, I'm thinking definitely keep it for another 6 months, I'd say, on the fundamentals.
And right. just as like a full disclosure, like I am a buyer, I own shares. I intend to add, assuming it's around the current price. So, full disclosure on that there.
Fair enough. Thank you. And of course, we own it in the fund as well. All right, now WO1. I just wanted this one talk about through yesterday's chat was absolutely fantastic, and today they come up with drilling results. So obviously follows people in the know were buying due to the fact they knew there's probably going to be some results coming through. The results were good, weren't anything spectacular, I must say. So maybe a bit of profit taking today. Maybe we'll see. It's obviously up 22% for the week, but today I think let's just have a look what's going on. I think slightly up. 2.5%. Yeah, that's not too bad. But like I said, I think the bulk of it is a pretty good run already. Maybe the sentiment's turning again a little bit positive on the lithium space. So you're going to look at it. But still, if I'm going to choose between WO1 and PTM is the one that's really delivering the crazy numbers, right? So this one's good, but not quite as good as the other one. Still would be puntable for sure, especially on that chart for the weekly. So let's hope it ends like this at the end of the week and still probably a buy by then. But I would not be rushing into it right in the middle of the week. I'll probably wait to see where it actually ends. All right, let's go to CGS because they've come up with an update on their performance, some cost cutting, well, shedding some stuff. What do you think of this one? Have you had a quick look at this one?
Yeah, so I follow this one as well. Don't own it. Look, not a bit of a downgrade there. Yeah, it's just like, the companies, they get into that downgrade cycle, don't they? And so the previous one was quite a severe downgrade.
Yep.
That at the minimum end of it took them down to I think it was 2.2 million US dollars million as my projected I think it was EBIT maybe. Got to check on that. The numbers are swarming around my head, but basically the way I see it, there was a little bit of a downgrade. Actually, maybe that was an NPAT, and then that was my projected NPAT based on a normal tax rate because they'd given the EBIT guidance. Then now they're saying actual NPAT of, I think it was 0.6 to 1.6 million USD. And in that's taking 600,000 USD redundancy costs. So if you add that back in, they're probably tracking just a tiny bit below where their already downgraded guidance was, and they've decided to cost down. Your guess is as good as mine why they didn't just do the whole cost down hellhole thing, back in February, which is a few months ago now, because there's not really much point in delaying it just a few months if that was, that was something on the table. I think it just does highlight that Cogstate doesn't really have that much recurring kind of, I guess it's semi-recurring, but it recurs over a couple of years and then it dies. And so they need to keep replacing that. And yeah, look, I think that's just the weakness of the business. Like you want a software business to be as smooth as possible, or I prefer to be buying a more recurring style business. It's not even that I definitely have to buy a software business. I just like the recurring style thing. But talking about SRG for a moment, the entirety of the reason I bought that is because they're moving their business into asset maintenance, which is more of an ongoing kind of situation. Just makes it so much easier to plan and manage the building, the business, and optimize it. Of course, it's a rare beastie that is a business that's super predictable like that. But that's why you like to buy them, because they are rare and they are good. So Cogstate, whilst it has the potential to have high margins, whilst it has potential for significant growth, selling tools that are essentially, shovels in a supposed gold rush for inventing Alzheimer drugs and stuff. And they can really take off those kind of businesses when they have a boom. But yeah, the boom is not booming as hard as I thought it would. If you'd asked me a year ago, no way, Jose, and even the company's come under. So overall, to me, this one I've had a really tough history with this over the years. I think it's a really tough one for you. You have to have a good mental fortitude, good valuation framework for it, good patience. And definitely not one that I would see that the traders having much fun with, and even not one that I've had much fun with. So tend to be a bit cautious of it.
Yeah, look, I think you summarized it pretty well. I think they should be doing much better than they are in this, I suppose Alzheimer's or, the memory type problems that we've got, cognitive problems that we've got, of course, that have been addressed now. There's been a bit of few breakthroughs, yet it's a bit of a mess. That's what my problem is here. So certainly technical wise, pass on a downgrade cycle. You just don't want to be, and I know they're restructuring and whatever they're going to do to hopefully save some cash, but you wouldn't be touching it at the moment. But hopefully maybe one day they will come back over and we'll maybe look at it again. But right now, no. All right, let's go to the next one, EXP. And this one's actually come up with a fairly decent update. Just looking at what they've delivered previously to what they've come up with today, and there's I think about 100% growth. There's 60% growth from in a quarter, so it looks pretty good. So I think it's just again gives you the thematic of that the leisure travel space right now is really pumping and going very, very well. So you can comfortably trade those sort of stocks. I think, is it actually trading today? Let's have a look. I don't know if it's actually going up today or not. It's down, what, 3%? Is that right? So look, I don't mind this company, but I think there's better stocks in here. It's, I think, going sideways most anyway. So probably better better stocks out there, like the HLOs of the world. But anyway, not a bad update today. Next one, CSR. Now, interesting enough, and we're going to talk about budget in a sec, but these guys have come up with a decent update today and result. Even though it's like down slightly, I think a 1.5%. You know what? It's commendable that they've actually come up with a fairly decent result when you think to yourself that, you know, we're probably heading down lower growth in Australia and maybe some pressure on the building material stocks, but it's still going okay. So from that end, you know, I don't mind it, but we saw some budget stuff coming through, and I'll talk about it in a second. I'll tell you what I think about the whole thing, you know, when we get to that sector. Next one, APX. Now, APX for me, we talked about slightly. Well, I mentioned this yesterday on the back of that. Maybe they're going to have some AI positivity coming through, right? Unfortunately, today they come up with a pretty terrible update. So we're seeing it down about 60%. So there was a very, very negative, you know, overall mention that things are getting still pretty bad. They're just, you know, downgrading pretty much the bottom line, the top line. But there's some maybe positivity coming through with the AI over the next few years, where they might have some more work. They're going to put some more money into it and try to develop that side of the business for them. So look, maybe there's something later down the track, but right now you wouldn't be touching it for sure. All right. Couple of more.
Is one thing that's worth noting about Appen is as it grew, this company just absolutely expanded its cost base like there was no tomorrow. Very well paid executives, like absolutely just made out, you know, like bandits. Really got a lot of money, big operating cost base, zero leanness. And so as soon as that revenue's gone down, it's just absolute hell to pay. Yep. They're now starting to downsize the business to try and, you know, get more appropriate with what their cost base is. But they're talking about at the moment, like, you know, their annualized cost base run rate, including share-based payments, which are a real cost, is about 120 million per year. So yeah, like basically end of the day, you know, when this comes out all out in the wash in FY 2024, we may well see it return to profitability. But, you know, until then, it's just, can they cut costs fast enough to keep up with the falling revenue? Which, as you know, if you want to see how obvious it was that this revenue would fall, just Google the truth about the Appen business model, because you want to at least understand what you're buying. End of the day, this is a business, you want to buy it on stable earnings, on like 15 times earnings or something like that, you know, once earnings have stabilized. You do not want to be paying like 40 times earnings like this is some tech stock. That is just ridiculous.
I agree. I think definitely at the beginning, I don't think there was much understanding of the actual business. Then when we started looking at a bit further into it, and you know, we traded it definitely from time to time, had a pretty good time of it. But when they got too big, and when you actually start looking at potential, you know, its customers and what they actually do, I think yourself that this could be a high risk story, right? And it's obviously proven out to be. It's just
it just got massively overhyped because you know, people lumped it in with like Altium, and it's just, they couldn't be more different. Like, one is literally a labor hire company. We're talking about like little PPE, which I own shares in, you know, trading on 14 times earnings. That's where a labor hire company kind of belongs. Not at 40 times earnings.
Yeah. I think I think we've all, a lot of us misread this one. But anyway, it's downgrades galore. Hasn't still looked anywhere near coming back yet. And I know there's some bottom picking. There you go, dirty fingers again for everyone. Do not touch. It's still a long way away from anywhere investable, to be honest. All right, next one. Bubs, another one that's absolutely, you know, complete mess, right? Absolute mess. Came out today, sacked the CEO. You know, there's just no, the reasons I was like, they had to sack her because you wasn't listening. But I don't even know what that actually means, Claude. It was just really strange. And they also sacked one of the directors. It's just a complete mess right now. You would not be touching this. I don't know how they've managed to really fall off the tracks, really, because it's just, you think to yourself, you know, moving into the US, getting some traction there. China, you think they do a better job than that, but a complete mess. So pass for me, wouldn't touch it. Last one, and unfortunately, this one is we own in our fund, so I need to quickly mention it. Technology One in a trading hold today looks like a cybersecurity incident. Ouch. Hopefully, it's not as bad as some of the other stuff like MPL, Optus, IPH, and some others. But I think it's going to be this cybersecurity stuff or cyber breaches will be probably touch everyone somewhere along the line, any business you might own. So let's hope that TNE caught that early, and it's not going to be like a complete exposure of every single name again, because it's getting a bit boring.
The good news. The good news for you, Peter, is that I've talked to some cybersecurity experts, and it just seems to be that the way it is in Australia is that there's no effective punishment for cybersecurity breaches. Basically, his impression was, and he works in a company that is the kind of company that TNE is probably calling, oh, we've got a problem, what's happened, blah, blah, blah. And it seems that, whilst this sort of incident drives business for those kind of companies, it really does seem like there's no actual punishment for, TNE. So if we see the share price does drop for a while, like I'd even consider that maybe a potential buy the dip kind of opportunity. Not that I own it or necessarily will, but I just basically think I wouldn't worry too much. There might be a bit of dip. You can see what happened with MPL there. Like it was time to buy,
Exactly.
buy that there. You get a nice little run. Yeah.
Yes. I'm waiting for it. I'm waiting for it.
And there's an MPL is the most disgusting one of all, right? Because what was it? They were like, it was like people were like leaking HIV/AIDS status or whatever. Like, it's horrible stuff. Like, people leaking that somebody, has had.
I have not Koreans with my details. Sending me emails every single day.
Yeah. Well, not to mention that, but yeah. So overall, like MPL definitely, you would have thought that there would be some punishment, but apparently no.
Yeah. So yeah, I agree. I think maybe if there is something like a drop of the share price, I'm probably going to be buying, because if I'm looking at MPL, bugger you. But it's still not good reputation wise to have a breach like this. You want to have a nice and squeaky clean company, which is probably not impossible these days. But anyway, I still like TNE, so I'll look at it a little bit different light.
Well, one hopes, Peter, that this kind of incident is good for DropSuite. Yeah,
exactly. Yeah, that's right. Please get some software from DropSuite. They'll help you out with your troubles. All right. Anyway, let's move on to the next one.
Which, by the way, we own. Everyone disclosure.
Exactly. That's why we're hyping it up. But thought of the week and budget. So obviously we had a big one yesterday. Budgets talk. There's so many different sectors that could be affected, and they will be affected probably. But the question was posed to you: which company will benefit the most for you? You think, right? Which company do you think is going to be okay for the next 6 to 12 months? So I'm going to start with you, Claude. You give me your idea, and I'll give you my idea, and we'll see where we come up with.
Well, there's two ideas. There's the first one I'll go with, which is the one that it might be a smaller benefit, but I think it's solid no matter what, which is ACL. That's a pathology provider, very focused in Australia. So SHL, for example, Sonic, that's a global. Yeah, it should get some benefit, but maybe not as much. Obviously, they're trying to do a cheeky takeover of a bigger company, Helios, which I think you and I both see as a bit of a distraction, Peter. Not the best thing to be doing, but doesn't really matter. The more the point is that I think that all of the new changes they've made to encourage bulk billing and to encourage access to that GP first line of defense, that's good. It's good for inflation because, first of all, medical expenses really weigh on people when they go up, and this should bring medical expenses down. But also, most importantly, the basic logic here is more people going to the GP equals more likelihood that they'll get pathology tests. Now, of course, there are bigger problems. We need more GPs, blah, blah, blah. But, Australia has a fine history of stealing medical staff from England, and that, we're full steam ahead with that plan. It's very good for Australia. England trains them. We get them. Beautiful. And so hopefully that'll continue to go. The more we make it nicer for GPs here in Australia, the more we steal from England. So Great news for medical health in Australia. And I think that these guys could be a low-key beneficiary, but it's probably just a small bump. The bigger one that I kind of think more is, maybe to answer your question a bit better, it is probably a bit more of a positive, is BRI, which basically provides materials for construction. And this one's on my watch list. I'll be doing some work on this today. Don't own it. I do own shares in ACL. I consider it a defensive. BRI, this is going to be not a defensive. It's going to be a full cyclical business. However, if we zoom out of the longer chart, Peter, I think that you get an idea of they've had like a good run for a couple of years now. Obviously, been pretty good. Pretty good environment from them. Pretty crazy. How much they probably benefited from that home builder stimulus that was like everyone, will give you like heaps of money to put on an extension and that kind of thing. So, they've had a bit of a bump there. I think has a low PE ratio because of the concern that, this huge bump and freebie that they got, it's coming down. But as you know, I'm an immigration bull. I say, let them in. We have no talent in Australia. Let's just let it in. The bad thing about that, though, is obviously standard of living in it goes down. But the only way you can combat it is build. And at least partially, we're going to see some of that now. And hopefully long may it last. Like all we can do is just build, just go absolutely nuts on it. And then, hey presto, we're going to stay the lucky country. Even though we don't have, we're not like the talented people in Microsoft or whatever that are, doing chat GPT and all that kind of stuff. We're not doing that kind of productivity. What we do is houses and holes. And these guys are a houses beneficiary. Obviously, I think you mentioned to me that immigration looks like it should be expected to be strong. The only way to deal with it. And also these people, nobody wants house prices to go down basically. But like, the problem is you have a massive shortage. Like it's not even about to go down. Rent and all that's like going up. In the budget, they put in rental assistance. Now that's fine and good, but that just means the rents keep going up. And so as a result of this, they don't want to take away negative gearing. They don't want to take capital gains discount, which is fine by me. Like, I mean, it is and it isn't. Like I've personally done very well about it. I feel kind of sad for Australia, but whatever. It is definitely, we'll see these guys. Look, the only thing everyone can agree on is build, and these guys should be a beneficiary of that. Hopefully, we'll see them benefit from that. So that's why I'll be taking a look at that company. But just keep in mind, cyclical, not a high quality recurring revenue business or anything like that.
Yeah, look, I agree with you. I think this is a strong beneficiary of the budget, and I'm going down the same theme here, Claude, and that is, the two things that really stood out for me out of the budget was they're definitely boosting immigration short term with they want skilled workers basically to come into Australia, which, that puts pressure, of course, on their housing. So what they've done is, of course, the rental assistance, and they've also done, they're trying to incentivize for the builders out there to build units for rental, houses for rental, right? So they obviously want to build more, house those workers. They're going to come in. So there's going to be pressure on that. This is good for some of the companies, like you said. BRI, I think, is going to be a beneficiary of that. So I'm going down the route of BKW actually, and BKW is the cheapest brick maker in Australia. Really top company. It's not expensive. The actual chart looks good. By the way, your chart BRI looked pretty good as well. I don't have a problem with that either. So I'm just thinking that this, and the thing is, I have to call it. It is stimulatory. I mean, I know how much they want to say, oh, it's not stimulatory this budget, but it is in a way. In certain areas is actually quite stimulatory. And
we have to do it though, Peter, because what we've got here in Australia is a very nice country, right? Where people want to come. You're free to be different. You can worship whoever you want. You can marry whoever you want. You can say whatever, it's a good place. You can make a good life here. So whoever you are, and that's what we're monetizing. Best place on earth. I agree, but that's what we're monetizing. We're just a classic two-trick pony, and we're going to keep on doing our tricks probably for the rest. I hope we do for the rest of our lives. It's all we've got.
It's good.
We've got to just do it well. Like we have to take care of our country, make it a good place, and people flood in.
Yeah, look, but I mean, when you look at Australia, the population is still very small compared to what, what can potentially be here. So, the immigration things, plus the students coming in as well, this is all really putting pressure on prices on the housing, prices on the rentals,
Exactly.
those sort of things. So
See,
I
the
think,
good thing for Australia is you get a fully trained doctor or a fully trained nurse or a fully trained engineer. Like that is just you're just stealing value from another country, right? But the downside is that engineer, he wants a house right away. He's not a kid who's going to live with his parents for the next 20 years and then get a house. He needs a place to live today. And that's why you have this big boom in cost of housing.
Yeah, and of course, I mean, the thing is with him in Queensland, just Queensland itself, we are incentivizing, trying to steal police force from other states, right? Giving them cash. Come into Queensland.
I did not know that, but what a classic Australian move.
I know. So there's a fight between the states for immigration. Yeah. So you can see, it's a place to be. I reckon that's the place to really put your money into investing wise. So I think BKW, BRI, all those little companies, even CSI, I talked about before, they've done well because you think to yourself, there's a pressure maybe on the inflation, or they want to bring it down to cool the economy down, but they're going to do okay because of the pressure of immigration coming through. So I like it. This is the place, and I think we should be okay. So you should be looking at some of these stories for the long term. All right, I'm going to cut it here because obviously we've gone quite a long way. Thank you very much for joining me, Claude. I appreciate every time I see you talking with me, your ideas. So thanks for listening, everyone, and have a good day. And I'll see you again tomorrow.
Great. Thanks for listening, everyone. Have a great day.
Cheers, guys. Bye.